Righto, buddy miners. Bargains going out the door, GC.
Absolutely.
There is more conferences. The Global Resources Innovation Expo, GRX, Brisbane, May 20th to 22nd at the Convention Centre, hosted by Austmine and AusIMM. And talk about bargains we're giving away here, GC. $190 off your rego if you're an Austmine or AusIMM member. Code MOM.
And if I'm not a member?
Well, mate, it's not as good, but it's still bloody good. It's $160 off.
How good.
Using the code MOMNM, as in non-member.
And what's happening at GRX, Matty?
Mate, tell you what, 150 exhibitors. They're cutting edge of mining innovation tech from everything that is revolutionising the resources sector. Mate,
how good is that?
Get along, just save yourself money. Links are in the show notes. And speaking of other things that are just awesome, Trader Ferg.
Absolutely. He's back.
Mate, check out his Substack if you're not there already. He is the counter-cyclical king, you'd say.
Absolutely.
Mate, so we've had him on before. He's a well-known figure in the investment community. And, mate, we talked... What have we? I had to write them down because there was so much.
So much,
buddy. We talked inflation, China, gold, coal, PGMs. Loves his rhodium. Loves rhodium.
I don't even know what that is, but I'm excited to learn about it.
If you talk to Ferg, you should love it. Mate, bloody cobalt, uranium, offshore oil. Mate, we covered it all.
You covered a lot of ground.
And I love hearing his views, the way he thinks and the way he punts his money. Love it. So, mate, let's get into it.
Let's rip in.
Righto, money miners, we've got on the man I want to be one day, Trader Ferg. Mate, I'm still in envy of your life, big fella.
Thanks. Yeah, no, great to be back on, boys. Always.
Right,
I love the channel. Honestly, you tackle the questions. I'm honestly wondering some days. I like see some news and then the video pops up a day later. I'm like, that's exactly what I was wondering. Perfect timing.
Very good, mate. Well, the theme of this is always what is the most hated and what's a good entry point that Trader Ferg's looking at. So, boys, take it away.
Yeah, I think we can give you a bit of mutual admiration here because we love your sort of style, your writing as well, Ferg, and your ultra contrarian kind of nature. And I thought it'd be cool to start this convo reflecting a bit because you wrote this wicked piece called Moats and Cannibals, and I'd encourage anyone who hasn't read that one to go and have a look just to get a feel for your writing. So that was about a year ago or so, and there's a lot of topics that you touched on there, from inflation to human behaviour and how you view markets, that I think are quite interesting and worth kind of reflecting on a year or so later. And I want to sort of frame it with one of these quotes that I just pulled out that you wrote. Embracing the cyclical nature of markets is the only way I know of how to make outsized returns. And I want to kind of hear your thoughts bearing that in mind on where we are in the cycle of the commodities or the various markets you're most pumped by, mate.
Yeah, certainly. Yes, I like that piece because that was kind of my overall framework for how I'm trying to position for the next decade at least. And markets are kind of simple when you really break it down, that all the markets are is sort of mass human behavior. And we're just always spinning between like fear and greed in certain sectors. And greed, we just are justifying price action and over projecting. And I think you got that with AI. And then there's the other side, which is the fear, and it's just nothing's too pessimistic. And this is where I like to hang out, which is like just how bad can it get that you're like you don't have to be that right to see a great return. And like some of the classic examples are just stuff going bankrupt. I love like you can look out for the phrases like terminal decline, stranded assets, like just multiple bankruptcies. I own a few companies that have gone bankrupt twice. And once you kind of understand cyclicality, you can see, like, sure, not everything's cyclical. Like, you can have a hard time if you're waiting for like fax machines to come back or something. But if you pegging yourself to a trend that you think is going to hold up for the long term, like energy demand, then it's all just an opportunity to have patience and set yourself up for great returns if you can stomach some volatility and keep your eyes on like the long-term fundamental outlook. And that piece was really just observing that I think we're coming out of a period of sort of loose money, low inflation, and everything that's worked in that period is going to stop working in what I see coming, which will be tighter money. It'll be higher structural inflation, and there'll be a lot of resource constraints just because we've underspent. We've just been pouring money into the likes of tech and especially the Mag 7. And if a point I was trying to make in that piece was if you the markets work on narratives, and like a big narrative then was like the power of, say, like network effects, where everyone just, there's no valuation too much to justify the power of a network effect. Well, that piece was really getting at the fact that I think there's going to be a lot of sectors where you've had so much capital put in and so much written down on the assumption it was not going to be needed, like the offshore rigs, whether it's even like thermal coal were both probably the prime examples, that they're just going to have a huge moat moving forward, and they're going to have outsized returns. They're super hard to compete with, like a sort of a drill ship. To replace it, you need you need day rates higher, and then you need the ship yard capacity, and then you need to put up 40%, and then you need to wait 5 years for it to come on, and then you've got to compete with companies that are holding all these assets that with no debt against them. So, and if during this period inflation's a lot higher, it just makes it even harder to compete with that. And so that's the idea of the moat. The idea is of the cannibal side of things is these companies are well aware that they have this moat, and they can start buying back their own stock. And so you can have these companies that could really corner their float during this period with a moat, and they could have substantial outperformance. And just on that back, they don't even need to have their multiples re-rated by the market. But obviously, once the performance comes, the market will probably start taking notice, and that's why I kind of see that being a future kind of narrative that the market really catches onto. But obviously, I'm talking like 5 years from now, which not many people want to position. And if I'm honest, like being in the whole offshore space has been absolutely brutal lately. So don't have much to show the last 6 months for this thesis. It's just been waking up every day and seeing them get hammered again. And the demand hasn't gone away. It's just been pushed forward a year or two.
The point on inflation, I think, is the one I want to draw on, because I think that is the one that dictates to a large extent all the other ones. And I'm keen to sort of get an update on your thoughts, Ferg. You wrote back then that we're in for a highly inflationary decade, and there's the sort of connotations on investing in hard assets, real assets, and all these sorts of things. How is your thinking on that big kind of picture cycle of inflation changed over the last year?
Hasn't really. Like I still think the end game's there. Like when you break down the situation the US is in, it's nice to see what they're doing with Doge and stuff, but it's too little too late when you look at the numbers. Like they already, like 87% of it's non-discretionary, or they're trying to cut. So they can't touch entitlements. They can't really touch defense, Medicare. Like all of that's already set. And so what they're trying to cut is not enough to move the needle when they're sort of 120% debt to GDP in the US. And so really you got three ways that you could balance things again. You got austerity, which is what they're essentially trying to do. You've got default, which why default when you print your currency, or you've got sort of inflate the debt to get it back under control. And that sort of inflating the debt to get it back under control is pretty much, I think, almost a certainty. And that results as well from And you just look where they're kind of stuck. Like they, if they push austerity too hard, as we've already seen, the stock market comes down. The stock market's a big part of receipts, and that's government income. And so once you crash that, then they have to print more to make the balance. And so it's just, you end up in the same place either way, that that they essentially have to monetize the debt. And so I just I see that occurring over the longer run, and just positioned for that with wanting to be in real scarce assets to and I've also kind of don't think the likes of what Europe are doing with the whole net zero policy and targeting wind and solar and just debasing energy. I think that's going to play a big role in it, because energy's obviously very tightly correlated to inflation as well. So I see that. Granted, it's no one's really worried about it at the moment, it seems, but I see that coming back in a big way.
Yeah, well, no one's really worried about bloody hitting open pit mining targets anymore, considering bloody MMS are in the industry these days. Bloody, you're just pretty much guaranteed to get to the ore early.
What a breath of fresh air.
Isn't it? And GC and JD, it's not coincidence, like, because the fact that they've got this whole tech services arm attached to it. Like, I'm talking the geology, the mining engineering, resource work, grade control for the geology, not just looking at rocks, mate, finding and telling you what the rocks are, all the pit designs, the pit techies, and that just complements the whole mining services side to blow the rock up and haul it to the crusher and make shitloads of cash. So
full service, Matty.
Mate, they've gone, old Refractory Rob's running it. Mate, he's gone from Refractory Rob to Extractory Rob, because he is extracting bloody open pit dirt like an absolute champion these days. So MMS. Anyway.
De-risk your operation, get MMS on site.
I will, JD.
Go the tech services team.
We can definitely talk about Europe a bit later on. There's one other lens, just to play devil's advocate here, Ferg, that I'm curious to get your thoughts on. And I'm largely in agreement with how you think about this. But you hear people, I think predominantly sort of from Silicon Valley, that'll push the growth narrative, and I think that is the alternative to the three kind of that you mentioned of how this kind of plays out. You know, the counter being they can grow their way out, and they do that through Doge and deregulation broadly to inspire growth in the US. Do you ascribe high odds to that happening and that being a means of actually minimizing what that debt to GDP ratio is?
Yeah, so to have high enough productivity that you can grow your way out. Yeah, I've seen those arguments put forward, especially on the back of like AI, just producing like a boom in productivity. I think the cleanest counter argument to that is the fact that large parts of the economy are off, and not, especially in the US, you're not allowed to compete with. And this is the idea that they've just been so heavily regulated, cartelled, like sort of duopolies, oligopolies, regulatory capture, that I don't think that productivity can even show up. Like there's this great chart that people can look up from Mark Andreessen, and he's sort of showing that they have a two-tiered economy, and you've got areas that supposedly AI should dominate, like education, and yet education inflation is just out of control. Like every year it's higher. Same with medical, like should really be sort of a breakthrough in productivity. But it's also captured that they just keep increasing costs, and everything that technology is going to attack, it's already kind of attacked. It's all the electronics, all the areas that we've seen just China essentially dominate. And so, and another great book on this is The Myth of Capitalism, which is arguing the same thing, essentially, that there's just been such almost crony capitalism across the whole of the United States, and the vast majority of manufacturing has been outsourced, that's not gonna change anytime soon. And if you did change that, it'd be so painful. We're back to the point that you'd cause a hell of a recession, and you need to print the difference to fund the debt again, and so you're straight back into the whole sort of inflation spiral.
Ferg, you hunt for these charts that just look like they're on a downward trajectory, like absolutely beaten up, and they've just been bottom feeding for ages. You look everywhere for them. If they're a cyclical industry, you put capital there, and then you're patient. Where are those charts at the moment?
Yes, I refer to it as now as like when the patient's dead. Like it's like you know when you're watching the medical movie and they're all the families sitting around and you see the heartbeat slowing and then it stops and you hear the buzz and it just goes flat. I'm looking for those charts, and I guess probably taking the analogy too far. I'm like, what could like be the catalyst to turn it around? Like when are the resuscitation coming around that could bring it back? And I think last time when I was on with you boys, I was just going through the whole PGMs trade, and that's been sort of a one that I see that a lot at the moment, particularly like we're just talking about rhodium, which is that's like probably when I'm thinking of like the absolute flat line and then the breakout, that's the most clinical one I've ever seen at the moment.
It's a beautiful chart, that one. Like the run up in that was it like, between kind of 2010 and 2015 is outrageous, and then falls off a cliff, and now you've got a bit of a breakout again. What's going on there?
Yeah.
I mean, it's a pretty thinly traded market, presumably.
Yeah, so it's opaque as all hell. So I'm going to start by saying I've got no idea. I've got no insight at all as who's jumping in there in volume. I've got zero idea. I could just throw out some conspiracy theories and some Chinese EV manufacturer hoarding because they see it as a byproduct. And
maybe someone's listening to you talk about it and thinking, I can squeeze this market.
How much have you got locked away, Ferg?
Yeah, a little bit. That's also the problem that I'm talking about as well. With like, I don't want to be seen as like, because I'm the only person that's actually I've come across that's even talked about rhodium. So it's like, are you trying to move? But it's been good because I haven't even mentioned it lately. So it's absolutely zero to do with me. And it does have some striking similarities to like uranium, and that I believe like 80% of it's long-term contracted. And so whenever those contracts obviously fall short, there's like 20% that trades on spot. And so they've got to go in and purchase it on spot. And in rhodium, it's a byproduct, so you can't really move supply based on supply and demand. It's largely just comes out of the bushveld in South Africa, and you've got just a reef around the bottom of South Africa where the platinum deposits are quite high rhodium. So rhodium is produced in a few other places like Russia with more nickel, Zambia, but in US, but it's all very, very low splits. So you're talking, I think Russia is like 2% split with their palladium dominant deposit. Zambia, it's about the same. US, it's even lower, like 1%. And then this one little spot in South Africa, you're up around 8-9%. And that's that's where sort of 85% of global rhodium production is. And again, this is all based on them essentially extracting PGMs. Like rhodium is just one part of that equation. And so it's hard to move the supply on that. And so when you're a pure byproduct, it really trades on like illiquidity. It doesn't really trade on fundamentals, I guess. Like when you need it, you just got to pay up for it. And this is why I loved it, is you get to sit there in a physical metal that's got is like an out of the money call option type volatility. And so by the time this airs, it's probably collapsed back down to where it was. But I just know that, when someone needs it, they're going to have to pay up. And it's done this 5 times. Like if you're talking cyclicality, this is probably the most cyclical little commodity I've come across. It 5 times already it's been a multi-bagger. And then obviously supply gets gets incentivized, generally because it goes hand in hand with PGMs, which is another point why this is quite interesting, is both platinum and palladium are both down. So it doesn't actually make sense why it's rocketing. It's not logical either. But yeah, if you zoom out, the biggest story kind of like I went through when I was last on is that the entire space is rolling over and no one's worried about it because they think EVs are going to rocket and there's no need for catalytic converters, whereas I hold a different opinion that the likes of BYD with its massive ramp in plug-in hybrids and their additional need for catalytic converters is going to actually drive demand up. And at the same time, all the plans to expand production either being cancelled or being pushed out, like Nickel, which was supposed to add 8% to global PGM production. That was supposed to come online by 2027. That was supposed to be commissioned in 2023. So that due to sanctions, they couldn't get equipment and said they'll push the project out. And that's yet to start. They haven't given a new timeline, but granted that timeline was 4 years. Even if they start now, still 4 years down. And then again, this is palladium rich. So two-thirds of their production is palladium. Like 2% is rhodium and the rest is platinum. And interestingly, their economics are driven by nickel because they're prominently nickel focused, and obviously nickel's in the shitter as well. So they're probably pushing out capex on the back of that as well. So it's a similar story across so many commodities. Is it's just all the investment looks horrible when you get out to 2030, like all the resources rolling over, and I think demand's going to be surprisingly strong. And yet, anyone trying to invest on that's generally had quite a rough time. And if you, I've got a small position in Sibanye, and they've just been beaten up in that. So that's why I kind of find the rhodium even more fascinating and why I probably chuck such a big slab in it.
We were in the bushveld and we'd visited a PGM operation. I sent you a message pitching you a stock, and you're like, "No, I'm happy holding physical rhodium and out of the money call options as Sibanye is my barbell strategy."
Yeah, exactly.
Yeah.
Well, I've been beaten up so much with miners that when I find something clean like this, because it's the other thing that's so exciting when you get to own physical is you inherently have a call option on South Africa going to shit, which has been a high probability sort of outcome recently. And whether it's load shedding, whether it's some of the bills that passed recently that are pretty concerning, I guess. And yeah, with physical and 85% of rhodium coming out of South Africa, if things do take a real turn for the worse there, you've got a call option on that because you can expect the supply to get a lot tighter. And so I love it from that angle as well. With Sibanye and increasingly Anglo American Platinum, with it just being sold down by its parent, it's just that's kind of a hedge that maybe palladium and platinum also run hard. And maybe there is potential that rhodium gets substituted in some way. It's you always got to be like, what can go wrong? And the thing with rhodium is you've got 85% of its demand is just purely catalytic converters, and there is a possibility that it could be kind of engineered out of a catalytic converter or severely reduced. Maybe some new AI can work out how to substitute palladium or platinum or some other element to really reduce it. And so it's not as kind of airtight as, say, uranium, where you just, there's 440 odd reactors operating and there's 65 under construction, and they're all going to require uranium. They're not going to all suddenly switch to 4M or something else.
It was the comment we heard when we were in South Africa was the loading of like platinum and palladium in some of these plug-in hybrids is decreasing pretty substantially over time as well, which again, I mean, that's kind of like the whole lithium intensity thing in the EV batteries that we saw play out too in some respects. But at the end of the day, at the moment, you still need it, and you need it in substantial quantities, even if there's a reducing load.
Yeah, well, they can only reduce it so much. So they've got the a lot of what I see extrapolated with China sort of going into like net zero, like Western media loves to pick certain headlines, like this is their solar build out, this is their, and just leaves out that they're sort of building a coal plant next to the solar grid. And one thing that most developing countries are pushing very hard is matching emission standards, because they don't want the smog. They've seen what sort of China and India have gone through. So the emission standards are quite high, and that requires sort of a minimum PGM loading. And then on the demand side, I think demand is just going to continue to surprise to the upside for these new energy vehicles, because a lot of the buyers are going to be first buyers. So they're just going to keep, the demand will just keep showing up, because now I know I'm seeing it here in Indonesia and Bali. I drove down to Uluwatu on Valentine's Day with my wife, and we just got stuck in traffic, and I just ended up counting BYDs, and I'd never seen them before, maybe 6 months, and I counted like 25, 30 on just the way down to Uluwatu, all brand spanking new, and you can pick these up for sort of 15,000 US, and they're just crazy, like build quality, crazy mileage, beautiful cars. And at that sort of price point, there's a lot of people that it's going to be sort of an upgrade from a scooter to that sort of vehicle. And I think demand's going to really surprise to the upside across the whole developing world, whereas it's going to disappoint across the Western world, which is where everyone's sort of pointing and saying, look at the tariffs, they're going to defend their domestic industries and stunt Chinese growth. But I don't think that's where China's looking to grow.
Can you get any exposure to who builds the catalytic converters outside of the materials itself?
You can with Johnson Matty, I think, Matthew maybe. It's a PGM sort of processor. A few people I respect have pitched that as a sort of an investment angle. I kind of went through it and I couldn't get nearly as excited about it as just going straight rhodium.
I'll tell you what I could get bloody excited about, Ferg, is Swick approaching 18 million drill meters.
Wow.
We know they're at 17 million, JD. 18 million's around the corner. And
It's a hard number to wrap your head around.
Oh, mate, I still haven't heard the absolute staple for underground exploration drilling. And, mate, they are going down there breaking a bloody record every day. Because I want to know what the record is for the deepest underground diamond drill hole ever drilled. Because if Deepex haven't drilled it yet, they're probably about to drill it. So, yeah,
Wow,
if
go
someone
Deepex.
knows that.
Any day now. Any day.
Any day. Mate, I just... the fact that they drill the longest diamond holes in the world is just nothing to be ashamed of. Oh, unbelievable. Go Swick, go Deepex.
Your point on on BYD is fascinating, and we're seeing it here in Australia as well. I think you can now get one for under 30 grand Aussie. That's the first EV to get below that price. And I also saw that in the top 10, I think it was 6th place, best-selling car in Australia is the BYD Ute. It's mind-blowing. And I think about stuff you've written of going long BYD essentially and kind of short Tesla. I know you haven't necessarily done this, but that's kind of broad strokes. How do you think about this, and how do you think about the super excessive valuations on some of these very popular names on global markets?
Yeah, I think Tesla's like the prime example of it, honestly. Like it's I think people just have PTSD from shorting that thing. Like you see the shorts have gone from 25% of the float for years to they're like 1.9% as of now, and the company's screwed. Like what? Unless they're sort of going to create robots. And I think I read an article a few days ago that Cathie Wood sees them producing robo-taxis that bring home like 90% margins within like a few years. And it's just all these like sort of Hail Marys to justify the stock price. But to me, it's getting eaten alive. You can see this in China. They have like 20% of their revenue in China, and they're just getting eaten alive by the Chinese manufacturers. Like you just can't compete in any arena that China's decided it wants to dominate. They really have just their industrial policy is second to none. So they just open their checkbook and they'll just absolutely start a crazy sort of competition war and fund them, give them subsidies, give them big orders from the state-owned companies, so that they got up to like 400 odd EV companies, and now it's whittled down to, I think there's like 70 remaining, but really it's 8, and really it's like 2 or 3 when you consider, I think BYD's now got 37% domestic market share in China, and it's just dominating, and no one can compete with that. And the problem with Tesla's valuation, it was priced like it was going to take over an increasing share of global market share, when it's just getting eaten alive. Like, you just put BYD next to a Tesla, and I couldn't agree with you more. Like, how every release by BYD is almost like when the iPhones used to come out. It's just exciting. Like, what are they going to release now? Like a Seal that can do 2,100 Ks on a single charge and a tank of gas. Their 4-wheel drive, which can float and drive across lakes, and it could sideways park or do a 360 on the spot.
The wheels that can fully spin around.
Yeah.
Crazy.
I heard they've even, I haven't even, don't quote me on this because I haven't looked it up. Had a friend told me that they're doing some sort of a flying vehicle, and I haven't even looked into that. I was like, just what is this company, and how is this trading at a 25 times forward PE, or I don't even think it's 25, I think it's like 21. And Tesla, granted, it's probably come down since I looked at it, but it was like over 100 forward PE. Yeah, it's long short was, I'd happily have that long short on, but I probably more happily have, probably a bit late now, but would have been like long rhodium, short lithium for a while there.
Well, they've got, even BYD's even got home batteries now to compete against the Tesla Powerwalls.
Yeah, they'll get big tickets from WA given the
because we just recently, like, WA's just announced 20,000 batteries get a $5,000 rebate from July 1st. So if that sort of takes off, imagine if households start taking up home batteries to connect to solar, and that becomes the addition to EVs. Like, how much weight are you putting towards the intensity for all the materials to go into them?
Yeah, so I haven't played the battery side at all because I just find it way too hard. Like, I think BYD is the perfect example of that. Is you'd if anyone had if you just had a flat spreadsheet of how many cars they're pumping out, and you'd rewinded 5 years, you would have thought the whole EV thesis was actually like on fire and had been really correct. But if you're looking at the details, what they label new energy vehicles, you'd realize that new energy vehicles are up like 80% year on year, whereas the EVs are, I think, they're 8%. So they're completely, I think nearly 60% of their production's now these plug-in hybrids. So they're almost they're really reducing the EV, the straight battery electric vehicle, out of their production line to an extent. And when you get into the batteries, so the assumption was it would be like a whole lithium battery for a car. Now it's only a third of that with what you need in a plug-in hybrid. And then they switched to lithium iron phosphate, and so you've only got a third, and you got lithium iron phosphate. And then they built a factory last year that's switching to sodium ion, and that's nameplate capacity. And sodium ion can pretty much do their current production in their plug-in hybrids. And then their chief technology officer came out a month or two ago and said, yeah, we'll have solid state batteries. We'll have demonstration by 2027, and we'll have it commercial by 2030. And it doesn't seem like a company I want to take the under on. Like, if Elon said that, I'd kind of have a giggle, but BYD's chief technology officer, I probably wouldn't bet against that. So, yeah, to your question about sort of the to them doing sort of the Tesla Powerwall, like, what battery chemistry will that even be? Will that be a solid state? Will that be a sodium ion? Will that be because I always saw there was a lot of talk of just how big the lithium ion industry would be. And I was always like, that's a massive assumption that it's the ultimate winner.
Mm. A battery material that you have spoken about in a sort of broader way on electronics is tin. What's your latest thinking on tin? There's been some very interesting geopolitics that we've touched on in the past in the world of tin, specifically in the DRC, and the one real Aussie name has moved quite well in the past month. What's your latest thinking there?
Yes, I love it. I wish there was more ways to play it because I don't want to size just a single miner up too much. I always avoided alphamin purely because I've just got too much PTSD in Africa. I don't care how good the mine is. I just don't want to be in the DRC, and prefer to have a safe jurisdiction in Australia. And there's a kind of a great risk reward at the moment because people were so, with Metals X, they were just annoyed with how poorly they've allocated capital for years. And they were like, oh, they're going to do something dumb like building up the cash buffer. And now, if they can get the other half of Ransom from this JV, that's pretty bloody accretive. That's a great use of the cash, especially with, I think the market supply came down, but demand also came down. So the market hasn't done a lot, but it's been sort of slow, sort of disappointing growth out of China and some other developing countries that have brought sort of electronic demand down. But I don't see that as like kind of a long-term trend. I see that kind of surprising to the upside, and I don't think supply is going to follow it. So all things equal, I think tin's going to keep surprising to the upside, and there's very few ways to play it. And so I'm a massive bull on Metals X.
Ding, ding, ding on Metals X. I saw a headline last week out of Reuters that Myanmar's major mine there, which has been kind of shut down for the best part of the last 2 years, has been signalled to return. The Myanmar mine in the WA state there. Have you thought about that? Any kind of short, medium term kind of headwinds on the tin price?
No, I've got to have a dig. I haven't actually read that article yet. Yeah, I need to put more work in. My understanding was it was quite high graded, so they weren't going to see a big production jump, but probably need to go through it again.
What about cobalt, mate? Well, the lads did a good episode on cobalt the other day regarding the new trust that is coming up. I don't know, we made up our own name, Cobalt Unit Trust. Speaking of things that are hated and nearly not breathing, it just seemed the journey this was about to take on with the ex-Yellowcake folk involved, and they got the deal with Glencore to buy cobalt for it. It looked like very early stage sort of spot Yellowcake arrangements when I guess they accumulated a lot of pounds at lower prices, and then obviously spot is retracted a lot now. But how do you view cobalt? I assume that has to be right in your wheelhouse of hatred.
Yeah, it's certainly hated, but I don't see where the sort of big demand boost is going to come from. So I can't get that excited about it here, honestly. And I kind of got, if I were to, it's similar to nickel. Like I agree, it's hated, but I just I don't know where the sort of the demand upside is. And I don't have a sort of a clear view on it, unlike, like kind of like PGMs, how I've got a clear view why the demand's going to show up. I don't really have that cleaner view. And so probably for now, it's stay in the sort of too hard basket, I guess. Granted, I'd just happily be long almost any commodities. I think people will do well in the vast majority of commodities, just as a point two of higher structural inflation. I just want to be in the ones where I can see like a strong bid for demand that I don't think anyone's thinking about.
I think that's a true measure of hate. If it's hated and you hate it, that is the that is the ultimate hate that any commodity can have.
Well, I just haven't done the work. Yeah.
Ferg, I'm really interested to dive into the various sort of cycles at play. We started by talking about this broader kind of cycle with the big names getting a lot of attention in markets like the Apples and stuff of the world, and then all the other places you play in have their own kind of cycles. And when I think of the likes of uranium, coal comes to mind, offshore oil services, a lot of these from, say, roughly 2020 to 23-4 were in an upcycle and they were doing well. And then those three, not all of them, but those three come to mind as having peeled back a little bit in certain regards. You know, spot pricing on uranium, coal prices have sort of peeled back. That was a sort of hell of a cycle they had. But some of those names are just hugely shorted now. So the offshore oil services names, like Noble comes to mind, and some of the other US ones are 15% plus, 10% plus shorted. Can say the same for the uranium names. I think of that, and you've made me think of this very well when you piece together the fact that the likes of Tesla, nobody wants to short them anymore, despite their insane valuations. What do you think's kind of happening there at a larger kind of market sense? It's more of a thought. I haven't put the question together well, but they're the thoughts I want to push on you.
Yeah. I think there's different reasons some sectors have been shorted. Like I'm going to be joking and just looking across my portfolio, and I have pretty heavy shorts in almost all areas, and even weird places like kind of Chinese tech, which I'm a big bull on, and some of the ETFs are up around 10, 15. There's even one ETF that's 40% short interest. And you go across to offshore, which I think what's going on there is like pod shops that generate great alpha. They just short on sort of EPS revisions next quarter. So they don't give a shit how cheap the stock is or where it's going to trade out like sort of a year from now. They're just looking like, will it likely revise down? And they just short it into that. And that's what I'm pretty sure is going on with offshore. Was the only real reason that kind of makes sense to me. Whereas, uranium, I thought it was kind of crazy until this whole, if they're betting that obviously Sport's going to have to sell pounds, that kind of makes more sense than if they were just betting on miners disappointing. It was interesting that when some of them did announce, and they weren't actually that bad releases, like the likes of Boss, there was no covering at all. If anything, they keep pushing up the short interest. So it means they're playing for something bigger. And that actually makes sense that they're playing for sort of a illiquidity event, which is it's kind of crazy. Like the whole uranium setup is just so ridiculous when you think about it. You've got this sort of monster demand that's required, that is 100% certain that it's coming. Like, in the further out, the more certain you get. Like, there's only, by the time you get out to 2040, there's like 3.5 billion pounds required, and only 40% of that's contracted. So if you kind of back that back to today, you've got the contract thing of that is like 200 odd million pounds a year. And everyone's getting their knickers in a twist that the likes of Sprott, Uranium Trust, what has it got, 60, 64, 65, they might have to sell sort of a few £100,000 until the utilities are inevitably forced to come to the table, because there's just not enough around. You can't operate with a sector where it's 60% uncovered and the miners are producing sort of 25% under what the yearly burn is. And this is all like, none of this is like kind of forecasting. Like, you know how many operating reactors are. These are multi-billion dollar pieces of equipment that have uranium when the lights go out, and they've been flexing contracts, they've been working through their inventory, and it's all kind of reached crazy low levels. And so it's the most absurd thing, because it's you've got this almost like a pool of petrol waiting for a spark for spot to move, and the utilities to start contracting in size, and yet you've got no futures market or anything to keep sort of spot market honest. And Spot does need to will need to raise some money by sort of halfway through the year, so you could have a sort of a real sort of illiquidity event there, and that's obviously what the shorters are pushing for. That does make a lot of sense to me.
Yeah, it's the overhang of this vehicle that we thought the pounds were locked up for infinity forever. Well, it kind of probably the narrative sentiment shift that can happen when everyone starts thinking that this vehicle should trade at a structural discount to NAV, as opposed to ever kind of getting to the place where it can trade at a premium, which allows it to buy more pounds. Those pounds kind of seem like they inevitably come to the market in some way, shape, or form once the narrative shifts that way.
Yeah, agreed. But at the same time, it's kind of a dangerous game as well, because there's I think Boss on just volume. That's like nearly 3 weeks to cover that position if they get trapped, and it does any sort of there's a shift in sentiment. People see it's just everyone's absolute laser focused on spot because the market's so opaque. It's like coming back to Rhodium. Like it's since there's no futures, there's nothing for retail investors to sort of grasp. There's no information flow really. It's just a handful of buyers. So yeah, it's going to be fascinating to see how it all plays out longer term. For me, it reminds me. I often throw this study around that was even God would get fired as an active investor, and it's this idea that like even if you could see what the top performing stocks would be 5 years out, if like they're using God just as like you knew with certainty what they would be, and you set up an active fund, like God would always get fired because he'd run too much volatility to get to the outperformance, and so he'd always get dumped by his investors. And so many opportunities feel like that at the moment. Like I can see this dirty big supply demand gap, but it looks like it's going to be a really volatile road to get there. And I don't know how many retail actually have the stomach to work through it, and whether, like when you point this sort of a setup out, is I've got some friends that have said, I'll just go to 50% cash and wait for the event to happen, then pile in there, kind of like waiting for a COVID type, like kind of just an absolute liquidity squeeze down. And I don't know if that's smart either.
Do you think if the spot keeps going down or even stays where it is at 63.50, do you think developers and producers are going to start looking at securing strategic inventory again out of the spot market possibly?
Possibly, yeah. I'd be a lot smarter than what they did, like securing it at sort of
in the hundreds.
Recent highs. Yeah, in the hundreds of them.
Straight after a capital raise.
Exactly, yeah. No, it would make more sense. It's just, even saying that, it's such a funny game of like musical chairs where everyone knows there's not enough chairs in the middle and the music's just going to stop eventually. It's like when you look at the bigger figures, it's just, I don't know. I don't have any smart insights on what's going to play out in the next few months. I'm just always like my mentor. Whenever I say anything like this, he's like, sounds like you've been too smart. Where's it going to be in 5 years? And almost just ride it through to that. And you just cause yourself so much heartache if you're trying to trade the market a few months ahead. It's just no one can do it, and you lose your sanity trying to do it. I don't think I've ever. It's actually been the worst thing that's happened to me. Sometimes I've one that was pure luck. Like I put out a whole thesis around Peabody about how coal, how big the supply demand gap was, how cheap it was, how it was going to be a fantastic investment. Put it out on Crux, this is years ago, and then Russia invaded, and obviously coal prices went through the roof, and everyone's like, that was you were spot on. And I was like, no, I wasn't spot on at all. It was just I just got lucky, like I feel like a lot of that is just understanding that the long-term fundamental thesis is there, but you're going to have an understanding it deeply, and you're going to have a rough ride to some of this. And that's why I kind of really am attracted at the moment to stuff that's not correlated. Like probably the most painful lesson is how correlated uranium and offshore oil have been. Like just having the correlation all just seem to go to one. Like they all just trade next to each other in a big chunk of the portfolio. So that was just pure pain. And whereas like if I map out some of my more recent investments, like I've got some tiny little like OSV shipbuilders that went bankrupt twice, Rhodium, Metals X, they're all doing Chinese tech. They're all absolutely ripping this year, and they're kind of helping offset some of the pain in offshore. So yeah, just focusing more on that sort of non-correlated bets, which is a lot harder than it sounds.
Do you think, just to close the uranium one off, do you think it's just going to be rough ride until we see a lot of, because these reactor builds obviously take a while, like China's probably the quickest at them, but getting to the point where so many are starting to come online, they need the initial £1.5 million to charge the reactor, and once that starts building up, do you think it's just going to be a rocky ride until then? Because a lot of it's all under construction, on the way, but there's not, to my knowledge, not shitloads of charging yet, but it will come when China are building 10 a year.
Yes, Mike Elkin's always been vocal on this, is that you don't need a additional, just the operating fleet. We don't have sufficient pounds on that and under construction. But as you say, everyone that comes on, and you need, 2 to 3 times the initial core loading versus maintenance. So that is like a sort of just bumps demand with every additional reactor under construction that comes on. Granted, they've already purchased it when you're starting construction.
You'd hope so.
Yeah, you'd hope so. You wouldn't be complete, and then you got nothing to put in it. Yeah, no, they're I just think everyone's tearing their hair out because of the opaqueness of it, and yeah, as you say now, with what everyone's latching onto is any name you look at, you've got a whole lot of short interest that is deemed the smarter money, and a sort of an event now by sort of June that supposedly Sprott's going to have to liquidate some pounds. But yeah, as I sort of ran through the numbers, that doesn't change the overall outlook whatsoever, and that demand's going to, to me, they've already pulled pretty much every lever they can. There's inventories are all record low. They've got to get the uranium through the fuel cycle, which takes a few years. It's not just sort of take it from the mine to the reactors. There's a whole fuel cycle there. There's been, if you look at all the stages up the fuel cycle, that's all been rocketing higher. So yeah, I feel like this is kind of like a mass extinction event for all the retail investors in it. Like, you've got to get them out before it can then run. And when that run happens, I've got no idea, but I want to be there for the start of it.
Chinese tech, Ferg, very hated sector. Even like 12 months ago, things changed briefly when David Tepper came out and was banging the table last year, and then like after really soaring off its base, like peeled back a lot of the gains, and then December, like the stocks were trading kind of like similar to where they were before that, and then they rocketed again. Like, markets sometimes they take the path of like Max Payne.
Always.
Are you still think Chinese tech is pretty undervalued here? Yeah,
this is my biggest position I've taken in one whack really, and so it's even been reinforced. Anyone that hasn't had a chance to go and read America First investment policy that was released by the White House a week or two ago, and there's this section in it and where they're now removing I can't remember what it's called anyway. It's a treaty with China that they can essentially invest in US assets with zero tax. And if they remove the treaty, they go from 0 to 30% withholding. And it's pretty damn significant when you consider China holds 2 trillion of US assets, and about 760 billion of that is in US equities, which is kind of fascinating when US equities before this announcement were already, particularly Mag 7 and NASDAQ, were kind of struggling to find their marginal buyer. And so US has just told them to, I've got a piece in the works at the moment. It's just telling the Chinese to get the fuck out. Like, just out you go. Your capital is no longer sort of welcome. And as part of them they can't fix the trade balance without fixing capital flows. Like, you can't just have money keep flowing in if you're trying to fix your trade balance, because it doesn't work. And that's the question there is if they're going to tell all that capital, that 2 trillion, sort of pretty much 760 of equities and I think it's roughly the same in treasuries to get out of the US. Where's that capital going to flow? And China's doing massive trade surpluses. So if they can no longer pour money into US equities, where's it going to go? And I kind of reached two conclusions as two kind of obvious spots for it to start flowing. It's either their gold, which has got a whole piece on that going through this just massive gap between gold and the gold miners, which is just getting absolutely ridiculous, and sort of their own equities essentially. And that's it's always been sort of a good rule of thumb is you want to be in front of you want what the Chinese want. You want to be sort of front running Chinese money. And that's when I go through my portfolio. I wrote a piece recently that was like, I just want to make sure every area I'm in, there's strong Chinese demand. I don't want to be fighting the Chinese in any area. That's why I wrote one piece on sort of shipbuilding, because I've got a few shipbuilding investments, and I'm like, am I competing with the Chinese here? Because I'll probably get my ass handed to me if that's the case. And yeah, I just love it. Love the Chinese tech angle. I wanted sort of a broad basket to catch all their national champions, like going to the back to the EV space when they went from sort of 400 to 70 players, and now the champion out of that, just no one's going to be able to compete with them globally. So they're going to dominate global market share, and I think we're going to see this across multiple sectors. And it's kind of absurd that they're all priced so stupidly cheap. Like some of these companies have got like a quarter of their market cap in cash. They're trading at like, before the run up, they were trading at like whole market valuations. So I love the trade, and I'll probably be on the trade for a decade, I'm assuming.
China, maybe 3 years ago, cracked down pretty hard, as I'm sure you're aware, on lots of different industries, and almost overnight they obliterated like parts of the education tech part, and around the time that like Jack Ma went missing for a little while, but he's back in vogue, and he's good friends with Xi again, and the whole attitude in China towards their national champions has really changed. How do you just think, I guess, broadly about your property rights? Do you just balance that with being so supportive in valuation with the cash balances that you speak about? Does that give you real support? And now with the CCP on side with a lot of these companies?
Yeah, I think that later party, like what you said, CCP being on side is the key factor. So they have to, like one of my favourite charts is from Lewis Vincent Garve, where he's just showing that everyone is still so focused on the property bust, and they haven't realised that the loans in total to manufacturing are almost equivalent. I think, they're just below sort of peak property loans, and so they've poured absolute trillions into building up their manufacturing champions. And so it doesn't make any sense why they would sort of harm them. They're actually just pushing sort of, they want free trade globally because they know they're the most competitive. Like, why would they try and damage that? And this is largely because China's kind of changed its game. When you think about the China for the last few decades, it was creating enough growth to provide employment for enough people per year. So it was kind of seemed to be a rule of thumb that if they could create sort of 8% growth, they could employ sort of 6, 7, 8 million people per year and lift them out of poverty. Well, they no longer need to do that. Their demographics have rolled over. And so now the game is they need to keep providing higher paying jobs for their workforce and kind of fight their sort of declining workforce. Like it's, interestingly enough, they're one of the biggest investors in robotics, where everyone sort of, if you don't show someone that chart, they always assume it's like Japan or somewhere else, but it's actually China. And so I think they're going to do everything to nurture this, their sort of industries. Chinese have a lot of cash, and they're notorious momentum investors. And so I think now that the property bubble's done, that those flows are going to divert into their own sort of national champions, and that could give it a very long runway. it's going to be incentivized by the CCP, and they're also talking of sort of stimulus to help get it, help keep momentum. And once they announce stimulus, they don't want you to sort of lose face. And so I think it's a very robust trend, and everyone's just kind of suffering from what we talked about with them. A lot of the Chinese tech being made to do national service and almost been sort of rug pulled by national interests over sort of their overall sort of profit motivated, like the actual for the shareholders. But I think that's changed.
Last one from me, Ferg. The valuations in gold you just touched on before, the massive divergence between the underlying and or some of the gold stocks is super, super interesting. So it's obviously a commodity that's not hated, where you tend to kind of play, but we just haven't seen the equities follow the underlying to the same extent. How do you think about that? How do you kind of position yourself for that today?
Yeah, so it's probably the most interesting divergence at the moment, because it just keeps getting wider. And what's fascinating is there is literally zero investor interest. So you can track this yourself if you just jump on Google and type like inflows into the likes of GDX, GDXJ, or even GLD, like just the straight gold ETF. It's not actually getting any inflows. If you take it back 3 years, it's still negative a few billion. GDX is obviously more negative, and GDXJ is just a bloodbath. And what's fascinating is even with gold's recent performance, if you bring up, I know GDXJ hasn't even had a single day of inflows for 6 months, which is kind of absurd when you consider what gold's the price performance of gold itself. And so what's going on here is it's obviously central bank buying. It's not actually any interest from investors to date, or investors that are trying to probably pick up physical and not playing it through sort of ETFs. Will this change? Well, say it kind of. So I'm kind of in a few minds with it, and the fact that like what's going to actually turn, like the charts are beautiful if you do the ratios. You can look at sort of earnings per share for the gold miners. It keeps climbing higher, but at the same time, miners being miners, all the sustaining cost margins are just blowing out as well. Got a chart in 2024 where it's just like a massive spike, and that's just like taking away all the profits you'd think you get from being invested in gold miners. And it's I think what's probably the probability in my mind is that gold's probably going to be revalued significantly, and that will bring investor attention back to it, because the gap will just get silly. And also, once we experience some inflation, a lot of the crypto projects will trade towards their intrinsic value, and people will have to start.
It's a polite way of saying going to zero.
Yeah, and people have to actually start concentrating on something with some economic use case, because I think crypto did really replace a lot of like what was speculation in junior miners. Like I've got one chart that's like all junior mining, the whole junior mining space, if you compare it back to the 1990s, was like 50% of the entire mining market. Now it's like sub 20. So it's just been absolutely decimated. And yet there's chart after chart where you pull out the supply demand picture and it just falls off a cliff out in the 2030s. And there's kind of like uranium, there's actually a need for greenfield. And but yeah, coming back to gold, it's just tough to play, but I think it is, a very, just how hated the junior gold miners are is kind of a fascinating setup here, and it's quite uncorrelated to a lot of other stuff as well, which I like.
For the producers, like the things with you compare gold to iron ore, for instance, like gold's the costs rise because they always got to be doing more capital to get deeper or do a cutback or whatever. Like you think of some of the best producing gold mines in Australia in history, like your Telfer in the heyday, KDR, Boddington, like those long life set up specifically Telfer and Cadia, or Cadia as a block cave, but you just don't see as much of it now because they're obviously wanting the gold now, so they'll go for the quickest way to get there. But doesn't feel like these big, massive, long life operations are being set up to be low cost producers during these environments. Like, which ones do you pick for that? Because technically, shouldn't Newmont be just making shitloads of cash on these long life assets? But that's been hammered.
You'd think. Yeah, you'd think. And it's honestly like I go through it and subscribe to some people that are gold pickers, and it's literally one of the hardest markets. Like like increasingly coming towards it is like you just got to have like a kind of similar to like a VC portfolio where you just have a basket and you assume there'll be some real outperformers in there. You don't try and pick winners because it's just too hard. And my record of picking like winners within mining has been pretty unblemished by success overall. So I don't want to play that game. I want to try and find smarter angles. Or if I am going to go in a miner, I want a real unique setup that I think I can, like something being kind of spun out of a major or some one-off event that really sets you up nicely. But yeah, like what you're just talking about, there's this great chart that, because gold's not underinvested in. I think gold's one of the largest, if you go through sort of CapEx by mining majors, it's one of the largest sort of outlays, and yet they've got absolutely nothing to show for it. You see kind of the chart is just higher and higher investment in sort of exploration CapEx, and the chart of finds is going the opposite way. It's just getting lower and lower every year. So it's kind of it's a interesting setup. And coming back to China, where I think with the US telling them to get out of all US assets, that's like the end of parking capital and treasuries, and the obvious recipient moving forward is gold. And it makes sense that it's kind of in everyone's interest that gold gets revalued at some point, because it's the only asset that doesn't really break anything. If you have like a 10x outcome on most commodities, you screw some people up somewhere in the world. Like if oil goes up 10x, and there's going to be a pretty deep recession and a whole lot of bad outcomes. But gold is the one that doesn't really matter because it's got no use case. And so I think on a long enough time frame, gold is going to get revalued very significantly. And it means the miners, all things equal, the miners should be great performers.
And like to your point of it being revalued at some point, because a shitload of gold gets produced, that's a lot of wealth to store.
Yeah, well, a lot of it's stored, like the US stores it all at a fraction of its. I think they all have it on the books at, I forget what it is, sort of $30 or $40 an ounce. And so they have a big injection. If they just revalue it to today's pricing, they get nearly $1 trillion, and more if it's higher at that point of time. But yeah, I think also because I didn't touch gold for years because I always saw it as a political metal. Like, why would you invest in a commodity where supply and demand don't seem to matter for the pricing of the commodity? And so every time demand would be too high, they'd just issue more paper gold. And what I see going on in China now is going to eventually cause the elimination of that paper market, because people are going to want, if you're going to settle trade in gold, you're going to need, want physical gold. You're not going to accept some paper. And so, yeah, I think everything longer term is quite bullish gold.
I think that's a welcome spot for a lot of people in WA to leave the conversation on. Thanks so much for your time and sharing your insights again with us, Ferg.
Thanks, Ferg. Legend.
No, love it.
Good on you,
always
mate.
have it. Come on, boys. Yeah, love the show.
Well, there we bloody go. Love a good chat with Ferg. As I said in private combo, when you're punting your money like he does, full-time trader, but then has such a long-term outlook on everything and can be settled in things for years, until it actually comes to fruition. That's a bit different to my techniques of trying to flip it for 20% in a week. But he's got some patience, and that's how he bloody if it comes off big. So yeah.
Absolutely. No, big insights from that chat. So thank you, Trader Ferg.
Oh, mate, Ferg is possibly coming to the GRX conference, he reckons, in Brisbane. May
Love it.
20th to 22nd, 190 or 160 bucks off your tickets if you use the exclusive link in the show notes. GRX conference hosted by Austmine and AusIMM. And bloody, there's also the AusIMM Underground Operators Conference in Adelaide before that, April 7th to 9th. And we've got $100 off there. We're just giving shit away here. It's
Love
brilliant.
it.
And I'd like to thank our bloody great partners at Mineral Mining Services, Grounded, Sandvik Ground Support, CRE Insurance, K-Drill, WA Waterballs, Gero James, Swick, Quattro, and Cross Boundary Energy, also known as CBE, also known as Tim Taylor. Thank you very much.
Hootaroo Money Minders.
Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.